Hello folks, welcome back to the channel. It's Solomon King here, and in today's video I'll be covering the concept of candle range theory. This is something I have gotten requests from so many people asking me to make this video, and I feel like let me go ahead and explain it in a broader way so that every one of you would be able to understand what exactly is candle range theory. So my goal in this video is to basically give you an idea of what exactly is candle range, how important it is for you as a trader, because that is the consummation of it all. If you will not be able to interpret it on your chart, there is no need for knowing the theory. I can just make the video for content's sake, but if you cannot bring it into reality on your charts, then it's of no use. Then the last thing is that I will talk to you about how to spot a high probability candle range and then low probability candle range. Of course, you will not be trading every candle range. You need the ones that properly align with your trading concept and strategy. And that is why we are trading in this industry. If we cannot take trades that will give us good results, then we are basically wasting our time. So this concept recently got popularity on the internet, especially trading space. And even though this is a concept that even a newbie is aware of, the name and the title, whatever was given to it, was just a rebranding. All right. So in simple terms, whenever people talk about candle range theory, what they are basically saying is that a candle is simply a range. All right. A candle is simply a range. And that brings us to the idea of time frame. So this is a daily candle. Let me start by that. And what this is saying is that the entire transaction that happened in this day, that is 24 hours, right, is represented in this candle. One candlestick. And let's assume this is a bullish candle. That means the entire transactions that happened in the last 24 hours was bullish. In simple terms, if that particular currency pair, GBP USD, for example, is represented here, that means GBP has been strong throughout the 24 hours, throughout the last 24 hours. And that is the receipt. Now, if we break down this guy into the lower time frame, this is the 15-minute time frame, right? We're going to see the entire price movement in such a way, right? Price had a break of structure, even a shifting market structure. Everything that happened that was represented within this daily candle is captured here. All right. So what this is basically saying is that a candlestick is simply a range. That means it has the low, or where we saw this, and the high, the highest level that that candle went to. That is why whenever we are taking a trade in a day, we have where the low of the day or the high of the day is formed, and we know how to trade it accordingly. Especially, for example, if you have followed my videos on the kill zone strategies, you will know that the London kill zone has the highest probability of creating either the high of the day or the low of the day, according to ICT. Now, this same candle range theory is the rebranded or another name given to our popular power of three concepts. Because everything that is covered in the candle range theory is captured in the power of three concepts. As a matter of fact, I have watched a lot of ICT videos and I've personally traded ICT concepts for a while, but I've never really had ICT mention about the candle range theory. I don't know if I am wrong, you can correct me, but then what ICT taught is the power of three concepts. It's the same thing. I hope you understand this. So, how can we really spot it, the reality of it? Now, there are three scenarios of this candle range theory, which I want to show you. Please pay attention to it in detail. Look at these three different scenarios. I hope you can remember your accumulation, manipulation, and distribution. This is a popular concept where we have the AMD formation. Now, there are three different scenarios that a power of three can be formed, or the candle range concept can be formed. We can find candle range concept in one single candle, all right, in one single candle. We can find it in two candle price action, and we can find it in three candle price action. Let me give you a very simple scenario. I will go to my chart. Don't worry, we're going to do practicals. We're going to spot it and how important it is for our trading as a general. So look at this. The first concept, price started. This is the lowest area, but this is the open for this bullish candle. Price opens, boom, it ranged, then it went lower, then it went higher, all right, and then it came back and closed at this point. Are you now seeing what I'm saying? The candle range theory. Let me adjust this one. So if you break down this candle, you have price accumulating, then sweeping the liquidity below here. If you break it down in the lower time frame, right? And boom, it went high, creating the highest level, leaving area of liquidity here, money, and it closed right here. The open, the low, the high. This is one candlestick CRT, which is the candle range theory. You can find it on one candlestick, just like this example. You see, price opened from here, all right? It moved high to that area after sweeping liquidity, because this is mostly a range, and boom, it went high and closed around here. If you break it down to the time of the day, this is the popular power of three concept for one candlestick of a day. It starts from a range within the Asia. This is why the Asian time is mostly known as a range. Let me give you a proper delineation of what I'm trying to explain. So if your Asian time starts as a range and manipulation comes in after the Asia has closed, this is why I said a candlestick can be seen in this simple format, and then distribution comes in. Distribution comes in during what? London/New York. So Asia comes as a range. Let's have it here. Let's have it. Asia comes as a range, and London comes with the manipulation, which is creating the low of the day. You remember the low of the day and distribution, then the close of that day. What is it called? The candle range theory. Candle is a range, the entire price movement. You can delineate. Don't worry, you will have every single detail properly given to you in this video. So sweeping liquidity and it went up. So in this same understanding, we can also watch other candle range formation that is not only one candlestick. Right? The second type is this one, where price went above the previous day candle, clearing the high or the low in different scenarios. Now, if we are actually on a bullish scenario, clearing the high of that and then targeting the draw on liquidity below. Clearing the high, targeting the draw on liquidity below. All right. I will talk to you about how to spot the most important one, because we need key levels that this will play out with properly. We need key levels that this will play out with properly. What I mean by key level is basically your point of interest. When I go for the practicals, you're going to see it. So right here, you have this one. The third scenario is when price clears the same and it continued downward to target the draw on liquidity. You can do this same thing for a bullish scenario. So these are the three types, or the three ways we can spot candle range theory. All right, candle range theory. So how important it is. The candle range theory formation must align with your point of interest. If price is sweeping liquidity and trading into, for instance, an order block by this side or a fair value gap, then this concept will play out perfectly, because we are going above this, sweeping liquidity, hitting the point of interest. All right. And then we have a shifting market structure. Then we take it for the bearish movement. Let me go to my chart and show you, because I don't want to do too much of theoretical part of this. Let's go to the chart. All right. So this is a practical example of what I was showing you. Now look at this particular scenario. All right. Price traded below the low of this daily candle. This is gold. The daily candle. Price have traded below the low of this candle, which is where the liquidity is resting. And after that, we saw price going above, pushing upward. What area did we locate? This bullish order block. Please take note of how price is trading and respecting this concept. So that particular bullish order block is where price traded into and quickly moved up. This is the second type I showed you. Price pressing below the low before going to the opposite direction. This is it again. Look at this one. We have this price clearing the liquidity above, trading into this area, rejection block. Boom. And what happened? Quickly moving in the opposite direction. The same thing here. The same thing here. Moving in the opposite direction. Boom. Moving in the opposite direction. Now, if you go through your chart, whether in the daily time frame, in the 4-hour time frame, you're going to see this happening time and again and again. Candle range theory. Clearing these highs, trading into this area before crashing down. You see, oh, this one has not reached that point of interest, but then it's something that if you go through your chart, you're going to see it time and again and again. You see the third type of, or the third scenario where you have 3 candles. You see these ones, price going above the previous day high and then targeting the low. All this draw on liquidity, starting from the internal draw on liquidity and finally reaching to that area. So candle range theory is basically those of you that are trading previous day high, previous day low, and then that concept is what has been rebranded to the candle range theory concept. But it must be aligning with a very important, or it must be aligning with a key level. All right. Look at this one. Price have this. The body of the candle. Look at this. This candlestick pushing into where? The fair value gap, which is the point of interest. And price went from there. So those of you who are trading the previous day candle high, if you sweep the previous day candle high or you sweep the previous day candle low, you target a point. This is the same concept, you know, price going above it and then crashing downward. So when you spot these things, they can be aligned in such a way that you can use it for trading. So now let's talk about how we can align this with the times of the day. With the times of the day. All right, is very, very important. Now let's look at this particular scenario. This is the candle range theory for a day, the one I told you about, the AMD. I used to use this indicator for trading this same concept of candle range theory. Now you can divide it into sessions where we have the Asian session. The Asian session is basically formed like a range for the day. This is the range, the high and the low. And what do we look out for? If we come to the next session, we basically look out for the sweep of liquidity that is resting above or below it, which is popularly known as the manipulation, and the distribution. It's a simple concept that repeats itself oftentimes, and you can see it on your chart. You can literally spot it without any stress. All right. The candle range theory formation here, you can see it happened right here. Price targeting the low of Asia. This one is simply for the day. And what did we see? Boom. It went up to that area. Now this is the same scenario we are seeing. So this same scenario, if you bring it in a candlestick formation, you will see it something like this. The candle body, and this is the high, this is the low, manipulation. All right, the open, and then it ranged, it went below to sweep liquidity below just a little bit, and then boom, it closed as a bullish candle. This happens many times of the day. You see, price have accumulation, manipulation, and it distributed to this side. All right, so you will see this happening time and again and again. The power of three concept is the same thing as the candle range theory. You have price sweeping the liquidity, going into a key level, and then trading either to the next direction to distribute or giving you a perfect trade entry. So always look for a confirmation. In conclusion, when you have your candle range, let's say this is the range, and you trade into either a fair value gap or a key level must always be there. A key level, whether you're looking at it from the 4-hour time frame or from any time frame. The key level is to basically help you know whether that particular area is a high probability area, because by the time you sweep either the high of that candle or the low of the candle, if you don't have any key level that will be important for price to bounce back from, it is going to be futile. Price is going to go up. So whenever you have price trading and sweeping liquidity above or below the previous day high into a key level or a point of interest and having a shifting structure, you can easily take the trade from there. And that is my basic understanding of the candle range theory. Nothing more, nothing less. If you can use this and blend it with your kill zone strategy, power of three is almost the same thing. All right, thank you very much, guys. I just tried to share with you and show you what exactly it is. See you in my next video.